What to know this week? Now, the stock market rally continued last week with the Nasdaq Composite clinching on the 8th straight winning week, while the S&P 500 continued its bull run with a 2.5% gain after key news on inflation and the pause in the Federal Reserve's rate hiking campaign. In the week ahead, investors would again keep their focus on the U.S. Central Bank, with Fed Chair Jerome Powell set to testify before the House Financial Services Committee on Wednesday and the Senate Banking Committee on Thursday morning as part of his semi-annual testimony before lawmakers. On the corporate calendar, earnings out of Fintech after the close on Tuesday will serve as a week's top highlight. Now, the shipping giant is seen as a bellwether of economic activity given its exposure across industries. Fed Governors Lisa Cook and Philip Jefferson will also be on Capitol Hill this coming week for confirmation hearing before the Senate. Cook was nominated by President Biden to fill a full term as a member of the Fed's Board of Governors, while Jefferson was nominated by Biden to fill the role of vice chair. The economic calendar will also be relatively quiet, with investors' attention on Thursday's initial jobless claim data continuing to build amid signs the labor market is softening, while initial looks at manufacturing and services sector activity from S&P Global out Friday will provide a look at how the U.S. economy is rounding out the second quarter. U.S. market will be closed on Monday in observation of Juneteenth. With less than 2 full weeks of trading left in the second quarter of the first half of 2023, all three major indexes are currently sitting on gains, with the Nasdaq now up more than 30% this year, while the S&P 500 is up just less than 15%. The Dow Jones Industrial Average, which fell 9% last year against a roughly 20% drop for the S&P and 30% decline for the Nasdaq, is up 3.5% so far this year. Last week, the Fed left its benchmark interest rate unchanged, marking the first time since January 2022 the central bank did not raise interest rate following a policy meeting. Still, the Fed's move was accompanied by updated economic forecasts, which suggested 2 more rate hikes will be needed over the balance of 2023 to bring inflation down towards the Fed's 22% target. Now, Thomas Simons, an economist at Jefferies, wrote in a note last week, the hawkish shift in the Fed's interest rate forecast helps to reinforce the Fed's message that this skip in June should not immediately be interpreted as the end of the Fed rate hike cycle. Inflation data out Tuesday morning showed the Fed is making some progress towards its goal of bringing inflation back to 2%, with consumer price rising at the slowest pace in 13 months in May, according to the Consumer Price Index, CPI in short. On a core basis, however, CPI inflation showed prices rose 5.3% over the prior year in May, well above the Fed's stated goal. As Powell said during the press conference last week, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Still, many economists expect the Fed would not need to follow through on the additional rate hikes signaled by its forecast. Although officials are now minded to keep going after that, we think that the weaker activity and employment, together with more encouraging signs that core inflation is moderating, will ultimately persuade the Fed that it doesn't need a final hike in September, wrote Paul Ashworth, the chief North America economist at Capital Economics, in a note last week. In the stock market, the conversation has begun to somewhat move away from the play-by-play of what happens next with the Fed, as AI hype continues to dominate the conversation. And it is becoming a near consensus view that this mania has played and will continue to play a key role in driving stocks higher this year. We now suspect growing euphoria over AI would drive the S&P 500 to a significantly higher level than we have previously forecast by the end of next year, wrote John Huygens, chief market economist at Capital Economics, in a note on Friday. As far back as April, strategists began circling the idea that AI hype was having a broader pull on the stock market. And with the so-called Magnificent Seven, mega-cap tech stocks Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and Nvidia haven't done much of the heavy lifting in turning the market around this year, the fundamental read-through is that incumbent tech giants will be the winners in the AI revolution set to sweep the business world. Though strategists at Goldman Sachs earlier this month made an even bolder argument regarding AI's impact in stock market, suggesting overall S&P 500 earnings could be 11% higher than currently expected a decade from now because of efficiencies companies may realize from AI. But if over the long run earnings drive stock prices and economic growth drives earnings, then many remain wary about the prospect beyond what has become a euphoric first half of the year. We're still thinking about economic downturn may take some heat out of the stock market in the second half of 2023, Capital Economics, Huygens wrote on Friday. Let's be clear from the outset, equities have nearly always fared poorly when the economy has turned down. Huygens added, since 1855, there have been 34 recessions in the U.S. and the stock market has declined around the vast majority of them. It typically peaked before a recession began and troughed shortly before it ended. Stock prices reflect expectations for future earnings discounted to the present, And it can certainly be argued that the current market rally has already priced in this heavily anticipated recession and subsequent rebound. Or perhaps the market is simply betting the recession everyone says coming never arrives.